Hi, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment markets to help better your portfolio. I've had a lot of questions about this recovery and also what I expect over the next 1 to 2 years, and what are some of the stumbling blocks that I see within the U.S. economy and also the world economy in general. I think there's 6 main aspects that really concern me that we watch closely. Not that I think we're going to go into a deep, dark recession again or have a credit crisis sell-off at the magnitude we did back in 2008, 2009, but 6 things that we are watching closely and things that will make us adjust not only our investment portfolio for our clients, but also maybe make us get a little bit more defensive in areas or basically take advantage of great opportunities, in my opinion. I think that the big thing that a lot of people are really looking at is obviously QE2 ending sometime in June, end of June. That really has helped promoted the economy, propped up the economy, however you want to put it, over the last couple years. So QE2 will be ending shortly. Will there be a QE3? I think there could be a possibility of that down the road, I'll be honest with you. I think there's more than a 50% likelihood. QE2 has helped asset prices. It's helped inflate asset prices, which makes the consumer feel a little bit richer. With QE2 ending, I think that could be one of those things that just slows the economy just a little bit if the consumer is not on board and spending at the rate at least where QE2 is ending. So again, that's one of the areas that concern me. I think one of the other areas that are of interest to most investors is, of course, the budget battles with the various parts of the House between the Democrats and Republicans. I think there's so many problems that we're going to have with this budget. Neither party really is addressing all the issues, and everything needs to be put on the plate. Not only obviously tax increases, but substantial spending cuts in all areas of our budget, as we are living well beyond our means within the U.S. economy. These battles are going to have obviously a negative impact depending how they're dealt out to the overall economy and especially to the stock market in general. I think those are some of the areas of concern. One of the other things that we're looking at is really commodity prices, and really looking at a long-term effect of commodity prices and how that inflationary effect will impact all consumers, because that is really the baseline, especially on food, for substance, of course. That's one of the areas that we're going to continue to see more and more pressure. I think we are in a secular increase or incline in the price of commodities across the board. Oil prices, of course, are way too high. At $110, $120 a barrel, that's going to put a huge damper on the GDP growth in this economy, and consumers really start to see the effect of higher oil prices once you get much past about $80 to $90 a barrel. And at a 110 to 120 price tag, obviously that's going to have a huge impact on GDP growth going forward. If prices continue to go higher, I think you could definitely see GDP being shaped easily 1.5% as we get into the 130, 140 price tag over the foreseeable future. Now, I'm not predicting we're going to see 130, 140 oil, but I think we are headed towards that direction over the next 3 years, certainly, as there is more and more demand put on oil, and the OPEC nations basically cut production, in my opinion, and raise those prices. Another area that I think is area that you really need to take a look at is I think the U.S. government is also going to be slashing GDP growth forecasts going forward. The lofty expectations of this government always amazes me. They're always, way above where things always end up settling, and really at their current forecast of GDP growth well in excess of 3.5%. I think by the time we get into the 3rd and 4th quarter of this year, I think we'll see GDP growth somewhere maybe around 1.5% to 2% tops. I think we're going to have very light economic growth, and again with some of the other indicators that I talked about earlier, I think that will definitely have an impact on where GDP growth is. At that kind of rate of GDP growth, 1.5%, you're just not going to create new jobs, and the job market is going to be stagnating, and you're going to have a lot of people on unemployment or unemployed for an exceptionally long period of time. I think one of the other areas that people are concerned about is China. They're concerned about China's red-hot economy. Their economy actually grew at 9.7% in the last quarter, which is phenomenal. And again, one of the reasons why we do have a major position in China based on the ETF FXI for disclosure. We like China. We like it a lot. Inflation's hot in China. It's run about 5.4% in the last quarter. So again, one of those things. But China's really trying to deal with their problem by raising interest rates, raising reserves at the banks, doing things that the government in the U.S. obviously never seems to really do or do correctly. So I like China, but again, people are concerned about the red-hot economy, and if they do continue to raise interest rates substantially, that will slow some of that growth. So again, some of the areas that we're looking at really is you're looking at inflation coming through in the U.S. economy, which again is going to be a problem. Commodity prices, oil prices, these are all stumbling blocks. China, if they try to slow their economy too much, it's obviously going to have an impact not only on the U.S. but the world economy. I believe oil prices are one of those areas that are going to hit every single consumer. We're already starting to see some of the effects of that. Generally speaking, I like what I'm seeing overseas. I like certain parts of the U.S. economy, but again, that doesn't mean that we will not change our portfolio when needed. I believe buy and hold is a lost investment strategy and something that is way overdue and should have been changed a long time ago. So if you are not making changes to your portfolio when necessary, I think you're making a big mistake. And one of the most important parts of money management is going to be risk management, especially in a down market. So if you don't know when to buy and you don't know when you're going to sell an asset or an asset category, obviously you're like a ship without a rudder. So having risk management and having a disciplined sell strategy is going to be more important than ever. This is Brian Resney with the Resney Wealth Report. Have yourself an extremely profitable day. And as always, if you're concerned about your money and you'd like to talk to us about managing your wealth, we are a fee-only SEC registered investment advisor acting in a money manager capacity. We're not annuity salespeople. We're not stockbrokers. We're not so-called advisors. We actually work as a money manager, fee only, without the conflicts of Wall Street and sales, and acting in the fiduciary capacity or in your best interest. Call our office. We'd love to meet with you and help rebuild your portfolio in a manner that's prudent for you. Until Sunday's show, have yourself a very profitable week.